All right, good afternoon. I'm here with my good friend Dave Gregory out in beautiful Philadelphia. Dave, we need to jump right into some of these real estate commentary and some of these real estate articles. I'm going to read. We're going to read from an article in the Wall Street Journal on September 8th. I'll link to this in the post, but the title of the article is "The Fall in Home Prices May Be Already Over. Quick recovery in prices suggests the housing downturn could be shorter and shallower than expected." So I got to ask you, everywhere I look, I see a pro real estate environment, and the environment, and a comment about it's going to zero. We're all in big trouble. What's your take? What are you seeing in the real estate? Should we be scared, optimistic? What's your quick take on things in general?
Yeah, I mean, we've been saying this for now a year and a half, but although interest rates have come up a lot for mortgages, you have a couple things in the residential real estate market that are really putting almost a floor on home prices. One is borrowers have a ton of equity in their house, and so home prices obviously ran up after COVID, especially in the suburbs, and unlike if you think back to the mid 2000s, everybody was taking equity out of their house. Mortgage underwriting standards were very, very lax. There was a big subprime market. And so over the past few years, we got a lot of home price appreciation, but nobody took equity out, or not many people took equity out. So the average amount of borrower equity in the US is, something like 50 or 60%. And so although we're not betting on home prices going up, we think it's very likely that they'll stay, sort of flatlined. We've been saying that, for a year and a half. It's basically what's happened. Home prices are actually up, a little bit on a national level over the past year and a half. So that's equity is the major driver of residential mortgage performance, because people aren't going to walk away from their house if they've got 40-50% equity in their house. So that's a big point.
That's a big point. Well, let's read from the article really quick. We're talking about the recovery in home prices in July. It says the surprising quick recovery suggests that the residential real estate downturn is turning out to be shorter and shallower than many housing economists expected after mortgage rates soared last year. Scarcity is a big reason. High interest rates have prompted homeowners to stay put rather than buy new homes and take on more expensive mortgages, resulting in an unusually low inventory of homes for sale. And then it goes on and talks about the difference between new homes, the turnover in new homes, and then the turnover in existing homes. And the turnover in existing homes has never been lower. Should we really be thinking about scarcity that much? I know the price for housing is set at the margins. And so if there's no selling going on, then surely it's going to drive up costs. How worried are you about that changing anytime soon? Or is this scarcity thing something that's going to be built in for a while?
Yeah, the lack of inventory, housing inventory in the US, that it was a problem before interest rates went up. I mean, basically there was an underproduction of housing ever since the last crisis. A lot of home builders went out of business. There's a lot of additional municipality regulations where people are pushing back on development, in certain neighborhoods. And, especially at the affordable housing end of things, it was a problem before interest rates spiked. And then once rates went from, sub 3% to over 7%, this mortgage lock-in effect basically exacerbated the problem.
Yeah.
And now, nobody wants to move. Nobody wants to give up their 3.5% mortgage. And, it's almost like the downturn never happened. Like it did happen a little bit, but when I think about problems in the housing market, it's really a function of anyone that's involved in housing transactions. So if you're a realtor, if you're a mortgage broker, if you're anything that depends on homes moving and people needing new mortgages, it's a problem, and it's probably not going to get any better anytime soon. But if you're betting on the performance of residential mortgages that are tied to houses, that's a completely different story, because the overall housing market has been pretty stable.
But yeah, let's read from the article here. The average principal and interest payment for homeowners with a mortgage was $1,355 in June. This is from a report by Black Knight. The median payment for those buying a home with a 30-year fixed rate in July was $2,306. So that's almost $1,000 increase in a month, just based on those mortgage payments going up. I think that further kind of talk about the turnover of housing, and that marginal differentiator, the price is just going to be there forever. How's it going to break, or how's it going to turn for housing prices overall? Do you think housing prices are going to come down? Are they going to stay up? How this can't go forever. The cure to high prices is high prices, as we've always heard. Is there any end in sight to this? These prices going up?
Obviously, home prices will come down at some point. I mean, especially in geographic areas where things just got way too hot. So on a national level, I mean, the major thing that drives home prices down is when you get a lot of distressed selling, right? That's really what drives prices down, dramatically. And, obviously we saw it in 2007, 2008, and that was a function of a lot of delinquencies in the mortgage market that crystallized into defaults, which drove prices down, and it became a negative feedback loop. And so the reason why why that's really unlikely at this point is because you've got such equity. So it would take a very massive drop in national home prices to push borrowers to a point where they've got negative equity. So it could happen at some point if there's a big economic recession, but given the amount of equity, given the fact that mortgage underwriting standards are much, much better than where they were in the mid 2000s, there's essentially no subprime market at this point. The probability of a massive increase or decrease in home prices is very low. It's really kind of in the middle, where you can make a pretty solid bet that things are going to be pretty boring, pretty benign and flatlined overall.
Well, let me ask one more question then. So home equity is really high. In fact, it hasn't been this high in a while, but a lot of that's paper economics, right? That's not money or capital in the fingers or the hands of an everyday person who has that equity. What are your thoughts about, if there is a recession, if prices keep going up, we see savings going down, we see credit cards going up, we see people increasing their debt. Is there a risk people will start to take that equity off the paper, put it in their pockets through home equity loans, home equity lines of credit, and then could that exacerbate the decline in prices? Is that something you're worried about or keeping your eye on at all as a portfolio manager or expert in the space?
Yeah, I mean, you want to basically pay attention to the overall amount of equity or if you think about it, the loan to value ratio. So if we get into a point where that LTV is starting to increase, either because you're getting a decline in home prices or you're getting additional borrowing, we're starting to see the second lien market percolate a little bit, both closed end and HELOC. And so, if we get to a point where the overall amount of borrower equity is a lot lower than where it is now, then that's something that we'll pay attention to. The important thing is just to take an honest view of the residential market and not be, we're not married to saying that home prices are going to go up forever or they're never going to go down. And you definitely want to pay attention to all the data points. I remember back in the mid, 2006, 2007, one of the first signs that we got nervous about the mortgage market was you started to see a small uptick in delinquencies for second lien mortgage bonds. And then you started to see an uptick in delinquencies for subprime. And it wasn't because of some sort of natural disaster where that's common. And it kept increasing off of 0 to 1, 2, 3%. And, we knew at that point, because underwriting standards were very loose, there was a ton of leverage in the system, that there was a high likelihood that was going to keep spiraling. So you want to pay attention to where the loan to value ratios are. You want to pay attention to any small increases in delinquencies that could eventually spill over into defaults. And right now we just don't see it on the horizon, or call it over the next year or two.
That's awesome. Well, let's end there, Dave. This is great. I love, be careful with my takeaways, be careful with the headlines, right? And you gave us two variables to look at. Let's look at loan to value ratios, because that's important. That's debt and delinquencies. I think that's a great thing to think about and consider. And you just said you haven't seen much of an uptick in there, and you don't foresee it in the next year. So I guess we can be optimistic for the short term about housing on the residential side, especially from a mortgage perspective. All right, great. Thanks, Dave. Appreciate your time as always. We'll talk to you again later. Thanks, everyone. Feel free to subscribe and pass along for others. Have a great day.